What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. Today, we're going to talk a bit about estate planning. So this is an important topic, especially for those of you with a lot of assets, or if you have assets in multiple states. So just a quick disclaimer, I'm a CPA. I'm not a lawyer. Odds are I may not be your CPA. So make sure you are taking what you learn and going and discussing with the professionals you work with. So nothing in this episode is considered legal advice. Also, every state has its own laws, and estate planning is really a highly fact-specific thing. So you need to consult with your own attorneys in your jurisdiction for advice tailored to your situation. So likewise, tax advice requires a formal engagement with a CPA. So now that that's out of the way, just make sure I don't get myself in any trouble. Let's talk about estate planning. So a lot of people think this is something that's only for super wealthy people or retirees. However, if you own real estate, be that a rental house or a vacation property, you already have a more complex asset structure than most people, and it needs to be dealt with when you're gone. So you don't want your loved ones tied up in probate court or forced to sell assets at a bad time because you didn't plan ahead. So estate planning isn't about obsessing over death. It's more about taking control so your assets go where you want with as little tax and hassle as possible. Now, why does estate planning matter for property owners? So we'll start with the basics. One, real estate is illiquid. You can't just split up a duplex the way you like, and as you would do with like a bank account. It's also subject to its own special set of tax rules. When you die, your interest in the property doesn't just magically disappear. It becomes part of your estate. If you don't have a plan, then the state in which you live in, or the state with the property is located, those default rules decide who gets what. So this could mean probate delays. You could have different court fees, family drama. So I've seen heirs wait for months or even years just to get clear title so they could do something simple like refinance or even sell a property. And things like maintenance, taxes, insurance, those costs continue to accrue. So without a plan, your heirs can inherit a headache or be forced to sell in a hurry just to pay expenses. So estate planning gives you an opportunity to decide who will own your properties, under what structure, and how they'd be managed when you are gone. So let's talk about two different documents. These are like your core estate documents. You have wills and trusts. So the simplest estate planning document's a will. A will lets you direct who gets what and can also be used to name guardians for minor kids. So it's better than nothing, but the downside is a will has to be probated. That means a judge supervises the distribution of your assets. Probate's public. It could be slow, especially if you own property in multiple states. So each state may require its own probate proceeding. So for real estate investors, a revocable living trust is usually the better option. So you create a trust during your lifetime, you transfer title of your properties into that trust, and you're the trustee while you're alive. So when you die, the successor trustee, who you name in the trust document, might be your spouse, an adult child, a trusted advisor, they take over. The property passes according to the terms of the trust without going through probate. It's private and faster. Trusts also let you put conditions on the inheritance. For example, if you want your properties managed professionally until your kids reach a certain age, then you can write that into the trust. Without it, your heirs could force an immediate sale just to cash out their share. If you have minor children or beneficiaries who aren't great with money, a trust lets you protect the properties from their poor decisions or from their creditors. So there's also when you die, your properties can receive a step up in basis. So that's a benefit of holding real estate until you die. That's one of the biggest tax advantages out there in estate planning for real estate is this basis step up. So under current law, and we say current because tax laws can change, when you die, the tax basis of property in your estate is adjusted to its current fair market value as of the date of death. So let's say you have a rental property that you bought for $200,000 and now it's worth $600,000 when you pass away. Your heirs they inherit it with a basis of $600,000. So if they sell right away, they're going to pay very little or likely no tax. Now, why does that matter? It's because real estate investors depreciate their properties over time. So the depreciation reduces your basis. If you sold the property while you're alive, you'd pay tax on the difference between the sales price and your adjusted basis, which includes that recaptured depreciation. So it could be a large amount of money that we're talking about if you sell during your lifetime. By holding the property to your death, that gain disappears. So it's going to reset the fair market value, and you're not going to pay capital gains. You're not going to have to worry about depreciation recapture. It's not your heirs. So that is this basis step up really has significant benefits. So that being said, you don't want to hold on to properties that aren't performing. Make sure you're managing your properties well, focusing on cash flow or whatever your goal is here. But at one point, we just had the one big beautiful bill pass a few months ago that has increased the estate tax exemption to $15 million per person in 2025. But and it did not touch anything it did not remove the basis step up. But at one point, a few years ago, there was talk about getting rid of the step up in basis. There was a proposal, it didn't go through. So just always be careful, stay on top of things. But for right now, that basis step up is huge. So that is a great tax planning tool. But laws can and do change. So you want to make sure you're staying on top of it or preferably working with advisors that stay on top of it for you. So estate planning is not a one-time exercise. It needs to be revisited anytime there's a major tax bill change or a major life event. You get married, divorced, have kids, anything like that. Now, let's talk a bit more how you hold your real estate. So I'm often asked whether you should hold your rental properties in your personal name or in an LLC. From a tax perspective, the LLC does not do anything, doesn't create any new deductions. You can get the same tax benefits either way. But from a liability and estate planning standpoint, usually in an LLC, using that as your entity, even a single member LLC, is generally preferred. And that's what I see most often. It's going to shield personal assets from lawsuits related to that property. In most states, if someone slips and falls on your rental property and sues, they can go after the LLC's assets, but not your personal. Now, again, laws vary by state. Some states have better protections than others. Be sure you talk to your attorney about that. But in general, the LLC does offer some liability protection. So they also make it easier to pass interest in your real estate to your heirs or businesses. So instead of retitling a deed every time you gift part of a property, you can gift membership interests in the LLC. Those interests are considered personal property, not real estate. And that matters because it avoids multiple probates if you own property in different states. So you may also avoid some transfer taxes and recording fees that some jurisdictions assess on deed transfers. And if for larger portfolios, sometimes you'll see something called a family limited partnership. It can also be a powerful tool. You as the parents can be the general partners controlling the entity. Your kids or trusts for their benefit can be limited partners. You can gift limited partner interests over time while still maintaining control as the general partner. Because limited partner interests usually lack control and marketability. Their value is often discounted for gift tax purposes. So that allows you to move more wealth under the gift and estate tax thresholds. So again, that estate tax threshold, there's an annual limitation, $19,000 a year per recipient. But then your overall estate is now $15 million, $30 million for married couples. So these sort of structures, gifting interest during your lifetime, tend to make more sense when you expect to be over that estate limit of $15 million or single or $30 million married. Though maybe you want to help or transfer interest prior for some other reason that is an option. We see that sometimes. So this is an overall comprehensive plan. So make sure you're really working closely with your attorney and tax professionals. Now, there are some gifting strategies as well. So we just talked about the annual exclusion. So the annual gift tax exclusion for 2025 is $19,000 per year per recipient. Does not go against your lifetime estate tax exemption. That's that $15 million or $30 million for married couples. So you can gift your kids $19,000 a year, or if you're married, you can combine gifts and do $38,000 per year per child or other beneficiary. It's not restricted to family. Gifting portions of an LLC interest each year to your children can gradually move value out of your estate. And if your estate's large, you can use part of your lifetime estate exemption while you're alive, if you like. That's that $15 million per person if you plan to make larger gifts. So that exemption also covers your estate when you pass at death. So the amount of your estate that becomes subject to estate tax is larger if you're making gifts that go against that during your lifetime. So again, just other things to consider here. There's another technique called that is a sale to an intentionally defective grantor trust. So you sell property to a trust in exchange for a note. Because it's a sale, you essentially freeze the value of what you transferred at today's price. The future appreciation belongs to the trust. So if structured correctly, you can avoid some capital gains on the sale, because for income tax purposes, you're treated as the same person as the trust. You can receive interest income on the note, and the trust uses the cash flows to pay the note back. So again, a lot of moving parts here, a lot of variables. Want to make sure you're working with professionals, but there are some options here. Now, if your overall estate, or if your overall plan is to be more philanthropic with charity, or if you're more charitable inclined, there's something called a charitable remainder trust that allows you to basically convert highly appreciated property into an income stream and also receive a charitable deduction. So you donate the property to a CRT, charitable remainder trust. The trust sells it without paying capital gains tax, and it pays you or a beneficiary an income stream for life or a set number of years. And at the end of the term, the remainder goes to charity. So this can be a great way to diversify out of one large property while supporting a cause that you care about as well. So a lot of options here when it comes to estate planning. We're only touching on a handful of items. A few last things not really related to taxes, but they are part of an estate plan. So you have powers of attorney and healthcare directives. So estate planning is more than just distributing your assets. It also includes planning for things like incapacity. If you own rental properties or businesses and something happens to you, it could be an accident, a stroke, dementia, who's going to collect the rents, pay the mortgage, handle your tenants, run your business? This is where a durable power of attorney comes in and allows someone that you trust to manage your finances if you can't. And without it, your family might need to seek guardianship through the courts, which is a time-consuming and expensive process. So similarly, a healthcare directive or a living will outlines your wishes regarding medical treatment if you're unable to communicate. So again, not directly about taxes, but it is part of a complete plan. If you think you're too busy for these documents, just stop and think for a minute that your spouse or kids are trying to manage your properties or your business while also fighting hospitals or courts because you didn't fill out these forms. Just very good things to have in place with your estate plan. Now, multi-state issues we touched on briefly. So a lot of real estate investors own property in more than one state. Each state has its own probate system. So dying with real estate in multiple states can trigger ancillary probate proceedings in each of those states. So you're going to have multiple court filings, multiple attorneys, multiple sets of fees. If you place each property in its own LLC and then hold those LLC interests in a revocable trust, your successor trustee can transfer the interest without probate anywhere. It's cleaner, less stressful for your family. One more thing to touch on briefly is life insurance, another tool in your estate. So if your heirs don't want to hold all the properties, maybe they need cash for estate taxes or debt, or just to buy out a sibling that doesn't want to participate. Real estate doesn't offer that immediate liquidity, but life insurance can. It can provide the cash to cover taxes and expenses without forcing a fire sale. So for larger estates, you can use something called an irrevocable life insurance trust, an ILIT. That keeps the insurance payout outside of your taxable estate. And I don't sell life insurance. I'm not licensed to do that. So I'm not selling you life insurance here. I'm just pointing out that ignoring liquidity needs is a common mistake. The estate tax is due if you have a taxable estate. it's due within 9 months of death. If all of your wealth is tied up in buildings, your heirs are going to have to find some other way to pay for it. So again, estate planning, it's not set it and forget it. Tax laws change, your life changes, marriage, divorce, birth, death, buying new properties. All of these events require review. And the estate tax exemption, again, just got increased to 15 million, 30 million for married couples. But if a new Congress comes in somewhere down the line, they could change that. It was scheduled to drop in 2026 back to somewhere in the $6 to $7 million range per person. If your portfolio was near that threshold, you could have been dealing with major estate tax changes, or estate plan changes, I should say. But we got the increase in the One Big Beautiful Bill. This is all just me repeating that regularly update your plan or regularly review your plan. Make sure your beneficiary designations are updated and current on any retirement accounts and insurance policies. And just work with your attorney here. So that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.